Good afternoon, everybody. It's Paul here. Here we are at Monday, the 29th of October. I think this is our 13th or 14th session of Mastering the Four M's of Trading. I appreciate that we have an interesting week ahead. Okay, in fact, the next 2 weeks ahead. Here we are in the UK. We're undergoing the sort of autumn budget at the moment. I appreciate also we've had a change in the sort of moving away from British summertime, and also we've got quite a few interesting things in terms of like school holidays this week, and also so there's lots going on. But as always, that means there's plenty for us to get involved with in terms of what we look at and how we can utilize our time to sort of learn and develop as traders, which is all what the Admiral Markets Mastering the Four M's of Trading webinar series is about. It's about helping you evolve, develop, and grow as a trader. So, as always, before we start the main element of our education today, I'm just going to begin with a quick risk disclaimer. Trading with financial instruments offered by Admiral Markets carries a high level of risk, which is not suitable for all investors due to their complex nature. Before entering into client agreement or making a transaction, please make sure to read the terms and conditions of our service. Consult a specialist if necessary to ensure you understand the risks involved in trading. This presentation and the accompanying video is for information and educational purposes only. Online educational materials are developed by Admiral Markets and distributed by Admiral Markets Group investment firms for a global audience. Therefore, please take into consideration that the information in this session may not be suitable for everyone. To get the corresponding information on charter conditions and any other details, please visit admiralmarketsglobal.com and select your country of residence and contact an appropriate entity. This presentation and accompanying video should not be taken as advice for investing, as they only represent the personal opinion of the authors, and the information is not directed at residents of the United States, Belgium, or any particular country, and is not intended for distribution to or use by any person in any country or jurisdiction where such distribution or use would be contrary to local law or regulation. As of August 2018, the regulation within the European Union differs for retail and professional clients. In our representation, we use demo trading accounts where all clients could still use a high leverage in a risk-free environment. Before opening a live trading account, please consider the differences between retail and professional trading terms. Retail clients benefit from unlimited negative balance protection. Professional clients at Admiral Markets UK receive a compensation of account deficits with a maximum payout of £50,000 sterling as per our negative balance protection policy. Admiral Markets, ladies and gentlemen, why would you want to trade with Admiral Markets? Well, they offer a fine range of products and services, and two of their best products and services are the DAX 30 and the Euro Dollar, both of which have a typical spread of 0.8 points or pips during their normal main trading hours. They also provide the Admiral Markets Supreme Edition of the popular MetaTrader MT4 and MT5 platforms. If you have any questions about this, or you wish to have any particular sort of guidance with the MetaTrader platforms, then please get in touch with your Admiral Markets account representative, and they'll be very happy to help guide you through that. Admiral Markets is a global brokerage. It has, as it says there, it's one world, but it has global offers and is actually regulated, authorized, regulated, and registered across a wider range of regulatory authorities across the world to provide sort of a global coverage. So, ladies and gentlemen, I appreciate a lot of you will be either joining us for the first time, or you've been with us for the series, or you may be watching this on demand on the Admiral Markets YouTube page or Facebook page. And in fact, what we'll talk very, very briefly about is, every week I go through a little bit of it's almost like building blocks from week to week to week to week, just adding another layer to our decision-making processes as we sort of understand and develop the sort of the knowledge of the four M's of trading. And for myself, a lot of it comes from my own background in trading. I'm primarily a dominant trend swing trader. I like to keep things very simple, and I personally blend fundamentals, technical sentiment, and geopolitics all together. Primarily, I trade FX indices, commodities, and I'm always looking to buy strength and sell weakness. And ideally, I prefer to use pullbacks for entries. So that's my kind of, call it my swing trading, and my intraday trading is I'm primarily a mean reversion trader. As I keep saying, that is something we'll cover sort of much further down in the sort of mastering the 4Ms webinars. As always, my expectations are, I'm here to help educate you about the 4Ms of trading so that you're in a position to go away and analyze any market and be ready to trade it, and also to help raise your self-awareness about managing risk and also about managing yourselves. For yourselves, ladies and gentlemen, I appreciate we always have a broad range of experience, that I also have time limitations of about 40-45 minutes, so that sometimes limits me in terms of the depth I can go into topics. So I'm always trying to give you things that you can use tomorrow. Okay, I want something that you can take away and use tomorrow to help you develop and grow as a trader. So those are the expectations which I like to set for every one of our sessions. If you've just joining us for the very first session, what mastering the 4Ms of trading is all about. Okay, it's about that. For years of trading, from my own experience, trading for myself, trading for funds, trading for clients, and also working with traders from complete beginners through to seasoned market professionals at tier one institutions. What I learned and worked out was that the traders who do well consistently, they tend to have a really good understanding and knowledge and ability to master the 4Ms of trading: markets, method, money, and myself. If you want to go into that in greater depth, then you go back and sort of see the first session that we did here. It'll be on the Admiral Markets YouTube channel and also on the Facebook page, and that will go into a little bit more detail about what each of those 4Ms. For the first sort of couple of months, what we've been focusing on mostly is markets and method, and as we go through, we'll sort of move across to sort of how we talk about managing money and also how we talk about managing myself. So, part of it in terms of like managing myself is, as human beings, okay, we tend to operate better when we have good habits, good behaviors, good routines, okay, and that's especially important for traders, So, we talked about how, just have a very, very, very simple routine that you can follow. I talk about how, when you go and get on an airline and you go fly to somewhere, whether you're flying to Berlin or you fly into New York or wherever, whether it be on holidays or business, your pilots get on, okay, and it doesn't matter whether those pilots are making the first flight of their careers or it's their last flight of after, 30 years of being an airline pilot. They will always go through their pre-flight checklists, okay? And the reason they do that is because it's a good habit, it's a good behavior. It basically means that they don't miss anything, okay? It means that they're able to operate safely. And it's the same with trading, ladies and gentlemen. You want to have your own little little bit of a pre-flight checklist that allows you to sort of operate safely time after time after time. Okay, that's what we were talking about here. And we talked about just having very few steps. Okay, a few simple steps. All right. Okay. Step 1: define levels of support resistance. 2: define if there's a trend. 3: look to see how price reacts at key support resistance levels. 4: look to see if we have some price action signals at those levels. And 5, which we started to touch upon last week, is is it part of a bigger chart pattern? And that's what we're going to focus upon today. So remember, as I say, every week I go through this very, very quickly, okay? And the reason being is that, what I want is, the more times you hear from me, okay, the more it sort of, sinks into your psyche, the more it becomes your trading belief, okay? And I'm a big fan of what Van Tharp says, that we don't trade markets, we trade our beliefs about the markets, right? And those beliefs come from sort of repetition, and saying that things we do, the habits we do every single day, okay, they become our standards by which we judge our excellence. And so every week I go through this, okay, just to remind you week after week after week, to be doing the simple good things, okay. Step 1: define levels of support resistance. Look at monthly, weekly, daily charts. Draw in those levels of support resistance. You might also draw in particular psychological round numbers, all right? And if you're struggling to work out which of those levels, we talked about how you can use the sort of fractal indicator to sort of help draw your eye towards particular levels that may be of relevance. Step two is, we talked about, for the beginning of this session, we're going to define ourselves as, sort of swing traders, end of day, position traders, okay? And for the most part, to begin with, we want to see if we can trade with the trend. Now, as you develop as a trader, that may change, but to begin with, this is about helping you, as I say, create habits, routines, behaviors that will allow you to operate effectively day after day in the markets. And I need to know that as a trader, you can just do the most simple thing, namely, define if there is a trend. Can you identify when you look at an instrument whether an instrument is trending or whether it's consolidating? Okay, very, very simple. All right, and you need to be able to work out when a market's going sideways and a market is trending. Okay, I'd say it every week. Good trends leap off the chart at you. All right, if you're struggling to identify if it's a trend, then it probably isn't a trend. Okay, good trends leap off the chart. We also talked about, from the charts, how we can use moving averages, okay, and you'll see on my charts, I have a blue 20-period moving average, a red 50-period moving average, and a green 200-period moving average. We talk about, some people like to use moving average crossovers as a trading strategy. Personally, I don't like them. I don't particularly rate them, okay? I think by the time they've happened, it's too slow. A good trader will already have identified, the sort of the turn or what the trend is there from price action. But what they can do is they can give us a good indication of where there is a trend, where there's the sort of the speed and the strength of that trend, and also they can become areas of dynamic support and resistance, which we've talked about how price can bounce off those particular moving averages. So, step three was, look to see how price reacts at key support and resistance levels, all right? And, I'd say, what does that mean? What it means is overall, I'm looking for a confluence of events. So I'm looking for somewhere between 2 to 4 things to come together at a particular time or price, okay, level that allows us to be able to have a confluence of events that gives me an indication that, this is a good place for me to be doing business. And that's as simple as that. And what we'll talk about is, to begin with, all right, okay, people might say, well, Paul, this is, you're being a bit simplistic here. But you'd be surprised how many people forget this, okay, when they get sort of knee-jerk, impulsive reactions of chasing markets. But, you just need to be reminded now and then. Markets are bullish, you want to be a buyer. When markets are bearish, you want to be a seller. Define that trend and trade with it. There's no trend, there's no trade for you at the moment. There's no signal, there's no trade. Just keep it nice and simple. Human beings, and myself included, we try to overcomplicate things, okay? We try and make things more complicated than they need to be, and that can be our downfall as traders. We just want to have a little simple plan that we can exercise week in, week out, time and time again. So, step one, define level support resistance. Step two, define if there's a trend. Step three, wait for price to react at key levels. Okay, that could be big round numbers, it could be the moving averages, if it's dynamic, or horizontal support and resistance levels in step one. And then we talked about, looking for price action signals at those particular levels, all right? And that's what we've talked about a lot for about the last 6 weeks or so is, there's some of those price action signals, very, very simple ones, okay, that you can sort of take and utilize, and look for in markets, the very next day. But, what we talked about in the methods was that, realistically, all trading and investing methods, they break down to one of two styles, all right? You're either trading a break of a line of support resistance or you're trading a bounce off a line of support resistance. And it is quite simple as that, okay? As I said, we overcomplicate things, and it's sometimes we just need to be reminded, that we keep it simple and that's the way we want to work. So, we looked at, various candlestick patterns as part of step 4. One of the ones, it's very simple. It's a very visual. It's a very popular one. Was a pin bar or a rejection candle. All right, what we talked about. It has to have the open and close within the range of the previous bar. The candle wick should be 2 to 3 times the length of the body. When you want to see a long nose protruding away from all the other bars. And actually, the better pin bars, they stick out and are very obvious. I'm sure that most of you have been able to have seen these on charts. They're very popular. But what we talked about is the underlying concept behind it is that my belief is that pin bars are likely indicators of where the biggest predators are lurking, right? Because it shows rejection of a particular area or direction. So we don't want to fight them, all right? We want to work with them to likely, as they show us the likely short-term direction, okay? And when we see them as giving us an opportunity to sort of rejoin an existing trend, that's a nice place for us to look to big trade. Then we looked at the engulfing candle, or sometimes called the outside bar, right? Okay, they happen much rarer. They are a much rarer sort of event rather than pin bars, okay, but they can be high probability because they demonstrate total overone. So we look to see them at the end of trends. They are a reversal pattern. So we look for a bullish engulfing candle at the end of a downtrend. We look for a bearish engulfing candle at the end of an uptrend, and we want to trade in the direction of the close of the engulfing candle. Okay, as I said, they don't happen very often, but when they do, you want to sort of sit up and take notice. We then talked about, a very simple, one of the weeks we talked about, just a very simple mechanical setup, okay, for traders. I appreciate that some of the traders, we want, just a simple mechanical setup that, they could take away and use, for their own trading, okay, and that's what we looked at, okay, and one of the weeks is that, simple mechanical pullback trading tactic to find if there's a trend, right, wait for the price to sort of pull back towards that support or resistance level. And if we're in an uptrend and then we're looking for a long, then we just needed 2 seller bars followed by a buyer bar. Or if we were in a downtrend and we had a pullback, then for a short trade we needed 2 buyer bars followed by a seller bar. Okay, just very, very simple mechanical trading method. Okay, that sometimes as I say, you just keep it very simple. That's what can help traders. What we also like to talk about how is, the sort of, let's call it like the trigger bar, the third bar, okay? If that third bar is also, something like a pin bar, an engulfing candle, or an inside bar, or a spinning top, well, that gives us more confidence. We're happy, we like that. That's what we want to. That's what we want to see for our trade opportunities. Then the week after that, we looked at inside bar. Okay, so it's very much the opposite of an outside bar, an engulfing candle, right? Because in this, the high and low of the bar is fully within the range of the preceding bar. And I talk about it all the week, every week about it. It's like markets are like humans. It's like like humans breathe. Humans, we surge, then we rest, then we surge again. And in the markets, okay, the inside bar is the rest. Okay, we've had a surge, markets take a little rest. The inside bar is the end of the rest, and then we're looking to position ourselves to catch the next surge. Yeah, that's a few examples. And what I was just saying is that I include the wicks, okay, as part of the the range of the bar. Some people just go off the sort of the body, but I actually include the wicks. So it has to be for an inside bar to be accurate and to be true, it has to be completely within the preceding bar. So I talked about, as always, you can trade them as pullbacks and trends. All right, if we were talking about being a longer term trader, if you're a so let's say a swing trader or a position trader trading around your day job, okay, and then we sort of just said just be wary of false breakouts. Where inside bars can help people is that they can also work in true breakouts. So you wait for a breakout to occur, then you wait for an inside bar to be printed after the breakout has occurred, and you want to trade in the direction of that breakout. Okay, so that's one way that some traders could use it for trading breakouts if that's the particular way that they like to operate. Then one week we talked about KDR and momentum reversal candles, key day reversals and momentum reversal candles. Okay, and it's just a key reversal pattern is a sharp reversal pattern that occurs during a 10 trend. So in an uptrend, price will make a new high on that session, but then close below the previous day's low. In a downtrend, price will either sort of open equivalent or below the previous day's close, make a new low, and then reverse and close higher than the previous day's high. Okay, they don't happen very often, but when they do, well, once again, you want to sit up and take note, okay, because there is something happening. And we also looked at momentum reversal candles, okay, which they're very similar to key day reversals. All right, we like to trade key day reversals, but they don't happen as often as we would particularly like. So momentum reversal candle is a kind of a more frequent version of it, but it's a little bit different. So it's for let's say for a buy, okay, for as a reversal pattern, the price is in a downtrend, price makes a new low. Okay, but it actually closes higher than the previous day's close. Okay, that's what we need to sort of be aware of. It closed higher than the previous day's close. Okay, so it's not like a key reversal. It would actually close higher than the previous day's high. Okay, so it's not as strong as a key reversal candle, but in the right place and understanding the confluence of events, well, then that actually can still be a valid trade idea. We talked one of the weeks about a little bit of a combination between a sort of 1T3 pattern and a key reversal combination pattern. So after a good trend, okay, if I take an interest if price prints maybe a reversal candle, okay, on the daily or the weekly chart. So if it's something like a key reversal or an engulfing pattern or a pin rejection bar, okay, then I like to see that, okay, after a long uptrend. Then I wait to see a sort of a 1, 2, 3 pattern form, okay, that provides me a lower high if market's been an uptrend. And what that's doing is sort of just giving me an idea that that market might be ready to roll over, and that gives me an opportunity to sort of get into a new trend. So just talk about how a sort of very simple bearish 1, 2, 3 pattern. Okay, price makes a high, price falls down to 4.2, and then price tries a last rally. Okay, but it can't break 0.1. Okay, and actually that once it moves down from there. Okay, normally once it breaks 0.2, that's confirmation that a 1, 2, 3 pattern has occurred. I talked about why is that pattern important. It's because the market is providing players a last chance to get on board the party bus. Okay, as it pushes up towards that 0.3, that's an opportunity for people who maybe missed the top, or people who've been sat on the sidelines to get on board. Okay, for the new move down. And excuse me. What I also talked about was 0.3 of the 1, 2, 3 should be, ideally a rejection or an indecision candle, something like a pin bar, an engulfing spinning top. It might itself be another key day reversal. Okay, but that's what we're particularly looking for. And also, a little optionally that, the 20 period moving average, remember that's the blue one on my charts, or if you use a faster moving average of your own choice, well then, ideally I like to see that turn, okay, from acting as a support to starting to act as dynamic resistance. Okay, start to act like a roof. It's capping any further move north. Okay, and that gives me more, as I said, it's confluence of events. I've got 4 or 5 things now all coming together. Okay, and that for me that's where ideally I'd like to be doing most of my business. So, and what you do is you trade the break of candle at 0.3, stop loss above the highs, okay, looking for either a 2-to-1 target, or you can use a 2-bar trailing stop if you prefer to use trailings. So, and talking about targets or trailing stops is actually going to be one of the future sessions that we talk about. And then, sort of last week, what we started to talk about was general chart patterns. Okay, and we started to touch upon that. So what we talked about, how, ladies and gentlemen, was about how. Here we go, the charts. There we go. So what we can do is we can effectively use lines of support and resistance. All right, they create various chart patterns that can actually be traded in themselves. And what we expect us to see is normally sort of 2 types of patterns. We have a continuation pattern and a reversal pattern. All right. Not unsurprisingly, okay, as the names imply, a continuation pattern is something where we expect the trend to continue once it's broken out of that pattern. Whereas, for a reversal pattern, we're expecting, the existing trend to reverse once, the price breaks out of that particular pattern. Last week, we focused a lot on continuations, okay, and this week we'll talk about a little bit of reversal patterns. So yeah, so we focused on continuations last week. This week is going to be all about reversal patterns. So last week, if you remember, we talked about bull and bear flags, ascending and descending triangles, and symmetrical triangles. And today, what we'll talk about is head and shoulders, double tops and bottoms, and triple tops and bottoms. Okay, and what we'll do is we'll have a look at cup and handles. Okay, and in another session, all right, as we sort of go through, but ideally, particularly, we'll sort of have a look at the interest it shows in head and shoulders patterns, double tops and bottoms, and also triple tops and bottoms. Okay, and head and shoulders and double tops and bottoms, I particularly like them as charting patterns, and I'll show you a few examples of them as we go through today. So if you remember, last week what we talked about was, in terms of continuation patterns, we talked about flags. So we had bull flags and bear flags, if you'll remember. Okay, and we looked at a few examples of that. All right, and we just talked about how a pattern, once a trend, price is moving up in a bull flag, it then sort of forms that flag pattern before the trend re-exerts itself. And we talked about how let's use the drawing tool here. Okay, we've got all the kits here, so let's use it. So what we talked about was effectively how the sort of we have the flagpole, okay, then we have the flag, and then what we're expecting is that actually we can project our target from projecting the sort of the flagpole forward. Okay, so that's what we'd be looking to do. Same for a bear flag. Okay, price is going down. That becomes our flagpole. Then it sort of pulls back. It creates that bear flag. As I say every week, I ask for your forgiveness about my artist skills. I'm a better trader than I am an artist, I assure you. And then once again, we will just be basically projecting forward. Okay, in terms of the flag pattern. That's how we would. That's how you look to sort of to trade flag patterns. We also talked about ascending and descending triangles. So, here you have the ascending triangle, here you have the descending triangle. Okay, let's get off the old drawing pen. So, what we expect is we normally have a level that that is acting as resistance, and what's happening is price is pushing up. Okay, and price is pushing up. And we can see that in that particular case, there's buyers coming in at these levels, and it's almost like a squeeze is happening. Okay, as the price just gets squeezed, and what we expect it to do is to shoot out again. And once again, what we'll be looking to do is to sort of take an idea of from the sort of the base where we came into the resistance level, okay, and project that forward as a target. Same for a descending triangle. We normally have a level of interest, okay, and then price is actually just bouncing. Every time it gets down to that level, it bounces, but you can see every time it's bouncing from it, it's bouncing. It's bouncing less and less and less. It's once again there's pressure coming from up, from above, from the sellers, and we're expecting it to sort of break out. And once again, we can sort of take our levels here, okay, and project them forward, all right, as our particular target. And then, last week we sort of finished with symmetrical triangles, all right, as the name implies. You can see what's happening there. Okay, prices. You'll hear me talk about it. Those of you who join me on the real-time daily trading ideas, okay, which is the sessions that I do between 4 and 5 every Tuesday morning between sort of 10 till 20 past 10. Well, then invariably what we'll see is that I talk about when I see symmetrical triangles starting to sort of show up. It's almost like price is coiling up again and again and again. Okay, and we expect it to blur. Now, normally what we'd be expecting, as I said, these are normally supposedly continuation patterns. So if prices come into that pattern from a downtrend, I'm more likely to have a bias to the downside. But sometimes that doesn't occur. It's more likely to do that. But I like to just basically just to watch and see how that. I like to think of that as it's price coiling up. Okay, it's price coiling up. Okay, it's getting tighter and tighter and tighter. And it's like anything, it's like a coiled spring. The more you talk about it, the more you watch it, the more it's likely to explode out, and that's what we're particularly looking for. So yeah, there was here's in one sort of page. That's what we talked about last week. Continuation patterns. Take a screenshot of that, stick it up on your trading wall. Okay, you've got it in front of you to be able to sort of identify what's happening there. Okay, be able to see them, and as I said, with all of these patterns, okay, all these patterns, all these price action charts, I can show you them, but what you actually have to do is just spend a bit of time in front of charts, drawing them in, sort of testing yourself, okay, seeing how they come on, okay, because the more you practice it, like anything, the more you practice it, the better you will become at it. So yeah, we said what we talk about this week is reversal patterns, okay? And here, once again, as I said, you can take a screenshot of this, okay, to utilize if you don't have it. But these are reversal patterns, and in particular, we've already looked at key reversals, okay? We've looked at key reversals, okay? But what we're going to particularly sort of talk about sort of today is head and shoulders patterns. Okay, double tops and bottoms, and sort of triple tops and bottoms. Okay, that's what we're gonna particularly focus on, right? And sort of source tops and cup and handles are something we'll touch upon a little bit later. Okay, they are valid opportunities, but I think what you'll find is that with head and shoulders patterns, double tops, and double tops and bottoms, you'll find that there are plenty of examples of that. Okay, you'll see in your own trading, regardless of whether you're, I don't know, a 5-minute euro dollar trader or you're a monthly gold trader. Okay, this is all about giving you ideas to take away that you can utilize regardless of whatever instrument you trade, regardless of whatever time frame you particularly look to focus on. So here's the first one. Okay, nice head and shoulders pattern here. Okay, so if you're very new to trading, okay, and trying to understand it, well, not unsurprisingly, it's a head and shoulders pattern. Looks like a head and two shoulders. Okay, and what we'd be expecting is price to sort of come up here. Okay, and we create a left shoulder, price comes back down, and then it pushes its way back up. Okay, and forms a new head. Okay. And we start to get interested in this particular area here, okay, and then effectively what happens is, price may fall down, and it may sort of come back to this area before it moves up again, and it forms a right shoulder, and so suddenly, as I said, we've got a left shoulder, a head, and a right shoulder, and that's just what we're looking to sort of try and understand. And in particular, what we become curious about is what they call the neckline. Okay, it's the neckline. That's what we're looking at. And in kind of classical technical analysis terms, what you would be looking at is the fact that you'd have, what you take is the distance between the sort of the head and the neckline, okay, which is that area there, and then you would project that forward, okay, from where the neckline is broken, and that would then become your target, all right. But like anything, the price breaks here, but it's not unusual for it to see it come back and test before it moves again. Okay, so that's a head and shoulders pattern, and you will see that on 1 minute charts all the way up to weekly and monthly charts. They happen on all time frames. Of course, the bigger the time frame, the longer it might take to actually to show up, and for it to actually to trade out. But it's but I assure you, you will see them across the spectrum, okay, of trading time frames. Here's an example. Now, I apologize. This is a little bit of a scruffy one, but the reason I showed you a scruffy one is simply because what looks nice in a diagram, can look a little bit scruffier when we look at the actual charts. And this is an up-to-date weekly chart of the DAX 30. Okay, the sort of German index. And what we've had here on a weekly is we've actually had a head and shoulders pattern here. Let me just draw it in. Okay. If you need some help, we had the left shoulder form here, where we came back down right to that area, and then we had a bit of a sort of almost like a double top head there, okay, but as the zone starts to become interesting, price comes back down to the area before it pushes up into the forming the right shoulder. It's as I said, it's a little bit scruffy. It in itself is a little bit of hard work, but we can start to see that there's a level there, okay, a level zone that is becoming our neckline. And we can see that actually, it was broken during the sort of sell-off. So we had a few weeks back. Okay, price had bounced back up. It retested it there. Okay, before it fell down again. And now what you'd be looking at is, well, that could actually be quite a significant distance to project down. Okay, and forward from there. Okay, back down probably maybe to where this kind of level of support is there. So we'll be expecting to see maybe price work its way sort of down there, okay, as we go. So sometimes the charts are not as pretty as the diagram, but you need to, as I say, you just need to practice, okay, practice drawing these in and looking at them time after time after time, and you'll start to see those patterns there. On the flip side, well, then you have what they call an inverse head and shoulders, all right, an inverse head and shoulders, all right, and as the name implies, it's the opposite of a head and shoulders pattern, and hopefully you can see there. Okay, let's just get my drawing pin out. Price is in a downtrend. Okay, it has a little bit of a bounce, and at that time you don't really know too much, but we extend. Okay, it extends past here. Okay, it goes down, forms a head, but it comes back up, and and then falls away. And actually now we're creating the second shoulder, the right shoulder. Okay, and that is also creating a neckline for us. And when we break that neckline, okay, that is where we're actually looking to start to be a trader. That's where the pattern is confirmed. That's where traders looking to get in. So, what we'll be looking at is, once again, okay, sort of projecting, all right, working out, the distance between the head and the neckline, and then projecting that, okay, forward as a target, okay, looking to have our trade in that region where the breakouts happens and the pattern's confirmed, and you'd have your stop beneath the sort of the right shoulder there, okay. That's what you'd be looking to do. So that's the sort of the simple insight into an inverse head and shoulders. As I said, it's a case of that they will show up on 1 minute charts up to monthly charts. It's just about practicing to sort of get your eye able to sort of see all of those particular drawings. So here's one. This is actually the FTSE. Okay, this is the weekly chart. Okay, and what was kind of interesting here is we had the left shoulder, we had the head. Okay, and we had the right shoulder was formed by the actual Brexit, by the sort of Brexit vote here. Okay, and we had a real messy period there. And I did a little TV piece talking about how I felt it was like an inverse head and shoulders pattern. Okay, and we had a neckline there, and of course as sterling dropped strongly, okay, that meant that the FTSE rose, okay, because lots of companies, the majority of companies, reported their profits in foreign currency. So actually, as sterling went down, it made them more profitable. So actually, we can see the price went down there, okay, and actually price rose very nicely for a good while there, okay. So that's a weekly chart. So as I said, you find them across all time frames. Now, admittedly, on a weekly chart, it takes a bit of time for it to play out, okay. But there's pros and cons to that, okay. And also I appreciate that sometimes it can be a big trade, okay, in terms of where you would enter and where your stop loss would be. But actually, what we'll do in future sessions is talk about how you can break that down into let's say a more manageable trade, based around your own sort of trade management and risk management practices, which we're coming on to in the next sections of mastering the 4Ms of trading. So that was head and shoulders patterns. So here's another pattern: double tops, okay, double tops and double bottoms. All right, quite simplistic in terms of the idea and what's happening. We can see prices moved up, price makes a peak, price falls away, okay, it hits support and it rises again. Now ideally peak two shouldn't break peak one. Sometimes it does, okay, but ideally it shouldn't, okay. Before price rolls over, breaks its neckline, and then continues on its way down. So you'll see this. Not surprisingly, okay, it looks like an M, all right, and that's why you'll see people talk to it. They might call it like an M-shaped formation. In let's say in future sessions, we'll go into the psychology of why these happen and why we're interested in them. But right for the moment, excuse me, I just want you to be aware of them. Excuse me. And be able to start to see them on the charts. Excuse me, sorry. So there we have that's a double top formation. Very happens quite a great deal. This is the S&P 500 daily. Okay, so we've had a really lovely drop, and as I say, those of you join me on the real-time daily trading ideas session, sort of London, 10 a.m. Okay, what you'll find is I talked about this a couple of weeks ago that we've been in a nice uptrend. Okay, here we go. We have been in a very nice uptrend. Okay, we also we had a double top formation. Okay, it was sometimes could be called like a 1-2-3 top. We had a double top formation. Price came down and fell, then it rose a bit, and then it fell again. Okay, and that itself becomes like a 1-2-3 pattern as well. There. But we had a double top, which effectively is it reversed the uptrend that we had been in. So not surprisingly, so in terms of we had an M-shaped formation to sort of signify a top. Well, here we have a W-shaped formation to sort of show us a double bottom. All right, double bottom. Okay, so it's just the reverse. Price is in a downtrend. It bounces from a particular area level. It comes up, hits a resistance level, comes down, and it forms like a second trough. Okay, and ideally it shouldn't be lower than the previous one. Okay, that's in the, let's call it a classical technical analysis, but sometimes that's not always the case. But as I said, a good double bottom formation will stand up very, very clear, and invariably as it goes and breaks the previous sort of the resistance line, the neckline, that is where people will be starting to look to place their trades, the stop losses beneath the sort of the lows. Okay, and that's where they'll be looking to sort of trade that breakout of the neckline of the resistance level. So here's an example from this is from oil. Okay, this is from crude oil. This is a daily chart here. Okay, hopefully you can see that's in a really very nice downtrend there. Okay, very nice downtrend. Okay, and we got a low here. Price rallies up. Okay, and hits the sort of a level that becomes support, becomes resistance. A price goes down again. Okay. We can see, it makes a low, but the low isn't, the low is a higher low than the preceding one. Okay, so we've also got a little bit of Dow theory there happening with making it a higher low. Okay, it's giving us that nice sort of a W pattern, and then when price breaks that neckline, okay, when price breaks that neckline, okay, then that's where people would looking to be getting long. Okay, your stop loss would be depending upon your trade management ideas and rules, might change, but it will be there. And we can see that actually price pulls up, it comes back down to retest that line. That's not really a retest that zone. That's not really a surprise before it continues on in that long nice uptrend. Okay, so as I said, this is a daily chart. You see some nice tops there. Okay, you can get some double top, double bottom formations. Those are particularly nice. Okay, as I said, yes, you might take a while for the trade to play out, but it allows you the time and opportunity to make a plan and to set your trade. Okay, that's that can help. Excuse me, that can help many traders as it stops them from making sort of impulsive knee-jerk reactions. Okay, we are all humans after all. So there you go. That's sort of a double bottom there on the oil daily chart. And finally, what we have there are triple tops, and triple bottoms. Okay, which is as the name implies, really, as the name implies, in the sense that. In the sense that we have double tops, double bottoms. We can also have triple tops and triple bottoms. Okay, what we'd expect is that triple tops they're hitting a particular level. And this is what makes it maybe different from a head and shoulders pattern. Head and shoulders, you normally expect the shoulder patterns to be much lower. Okay, and but actually what we're seeing is when we're seeing it hits in the same top level. Okay, well then we're into, as I said, it's a triple top formation, and then we're waiting to see price breakout. On the flip side, okay, you can have a double bottom. Okay, you can see for yourself here, your price is bouncing between those particular levels. All right, you can see that the bottoms are all in pretty much the same area, and it's when it breaks that sort of neckline to the north, when when it makes the breakthrough and goes up, that is where you'd be looking to be a long trade. Okay, they don't happen as often as double tops and double bottoms. Okay, but they can be quite powerful in when you see them. And as always, it's triple tops. They're very easy to identify in hindsight, but sometimes it can be a little challenging in real time. And the only way you get over that is to practice. Okay, is to practice being able to see them. That's the way that's the kind of way we like to look and work on. Super. So, I hope that gives you just a little bit of insight into some reversal patterns. Okay. Talk about. We'll have a couple of minutes to look at the charts. All right. So, talk about during the Mastering the 4Ms, what we're going to be looking at is we're going to be looking at sort of 28 FX pairs as well as the dollar index. We'll be looking at the major indices. Okay, the major equity indices. We'll look at some of the major commodities, hard commodities. Okay. We'll also have a look now and then at some of the FANGs, but just the interesting equities that are out there, and also Admiral Markets now also offer you the opportunity to sort of trade cryptocurrencies. So things like Bitcoin, Ethereum, Litecoin, and Ripple. They are now available to Admiral Markets clients. We will build that. We'll build that all into our, call it like our mastering 4Ms portfolio. And as we move up, sort of, let's say, more away from let's say, the sort of the slide educations towards the actual, the charts and markets as we go through that month after month. Well, then that will help build ourselves our own nice little portfolio of trade opportunities to look for. So as always, remember, ladies and gentlemen, it's about managing those 4Ms of trading: markets, method, money, and myself. Just ask yourself the quick question: are they all in alignment? Are you in a good space with all of those 4Ms? Okay, when you are, that's when we tend to trade at our best. So finally, if as always, if you have any particular questions about Admiral Markets or about this presentation, you're always very welcome to get in touch with your account representative. You can call them on that London line 02077264003. Email them hello@admiralmarkets.com. You'll be able to see this and all previous sessions on the Admiral Markets YouTube channel, and also on the Admiral Markets Global Facebook page as well. So as I said, don't be afraid to get in touch with your account representative if you have any particular questions or queries. So there you go. As I said, just very quickly, we've only got a moment or two left, but just here's a little bit of just to finish off for the moment or two. Here's here is a pound against the Canadian dollar. Hopefully, hopefully you can sort of see my charts. Hopefully you can see them. And what I'm particularly interested in here. Let's see if this is. We can see that we actually had a really nice move up here. And this is a monthly chart, remember. And then effectively, we had a real sort of almost like picture perfect double top there, didn't we? Okay, it's a pattern there. Okay, sort of a nice M pattern. Okay, sorry, as I said, my drawing's rubbish. And then once it broke that level, okay, once it broke that level on the on the monthly chart, we can see it actually it went pretty much down until actually what we got was, until we actually pretty much got a sort of a W formation, all right, which we had a little bit of a bounce, but then it came back down and really you'd probably be more looking at this as a bit of a triple bottom, and what you'd be interested in there is also that was that candle there. Okay, ladies and gentlemen, you can see that one there is it's not quite a key reversal, it's a sort of momentum reversal. It's it hasn't closed higher than the previous candle's high, but it definitely closed higher than the previous candle's close. Okay, so that was giving us a nice reversal there. Okay, after in that area, so then it makes it look like a little bit of a triple bottom there. Let me just put that drawings there, and hopefully you can see that's there we had a nice little run up there. Okay, for a few months, or almost for like 7-8 months. And what capped it was, well, the 50 period moving average acting as dynamic resistance. Okay, it was dynamic support. Okay, there is dynamic resistance, there is dynamic resistance. Okay, here we can see it acted as a bit of support, but actually it went through it, and then it became sort of dynamic resistance there. Okay, so that's always something to, as I said, to look at. Monthly charts, weekly charts, they're great charts to look at. It gives you an opportunity to see lots of amazing things there. Okay, and take a little bit of time to sort of build your picture with them. So there's always something to do there. Super, ladies and gentlemen. So I appreciate, as always, I try to cram in as much as I can. Okay, I try to give you a good recap of every session, and then give you some more. As I say, week by week, it's about just building and building and building and building. Okay, building some of your habits, routines, behaviors, and making sure you're doing the right things. Okay, so hopefully you'll maybe you'll join me for tomorrow for the Tuesday morning 10 o'clock London real-time daily trading ideas. Alternatively, I look forward to seeing you join me next Monday at 4 o'clock. Okay, for the sort of London time, 4 o'clock for the next session in the Mastering the 4Ms of Trading webinar. As always, wish you the best success in your own trading, ladies and gentlemen, and I look forward to speaking to you soon. Trade well and have a great week.